If you watch enough investing videos, you start noticing a pattern. Beginner investing advice almost always starts with a list. Here are 10 good funds. Here are 5 solid options. Here are a few you should consider. And after all that content, you're somehow left with more options than when you started. Why? Because that approach misses the real problem. Beginners don't need more choices, they need fewer. So here's the test I like to use. If I were starting from zero today, no portfolio, no sunk costs, what would I buy knowing I'd have to live with that decision for a long time? In this video, I'm answering that question directly. I'll show you the only 2 index funds I'd invest in as a beginner, and more importantly, why I'd stop there. I'll break down the role each fund plays, how they work together as a simple system, and how I'd turn them into a real portfolio without constantly changing things. And in the end, I'll show you how this exact 2-fund portfolio can realistically turn a $9 a day investment into a portfolio worth over $1 million, paying more than $7,000 a month in dividend income. To understand why this works, you first have to be clear about one thing: what investing is actually about. Investing becomes much simpler once you're clear on what you actually want your money to do. Don't predict markets. Don't guess which fund will outperform next year. Don't react to headlines. That approach sounds active, but it usually leads to mistakes. Do this instead. Own businesses. When you invest through index funds, you're not making a bet on a specific company or trend. You're buying small pieces of thousands of real businesses that are already operating, earning money, and growing over time. Your job isn't to outsmart them. Your job is to stay invested while they do their thing. This is why I like index funds as a starting point. They remove the need to be right. You don't have to know which sector will win or which country will lead the next decade. You just need exposure to economic growth and the patience to let it compound. At this stage, I'm not optimizing for maximum returns. I'm optimizing for fewer decisions. Every extra choice is another chance to hesitate, second guess, or change course. Fewer choices make it easier to stay consistent, and consistency is what actually drives results. This is also where the idea of roles start to matter. You don't need every investment to do everything. You need each part of the portfolio to do one job well. One part focuses on growth. Another part reduces reliance on a single market. That's it. When each piece has a clear role, the whole system becomes easier to understand and easier to stick with. Once you think in terms of these roles, fund selection stops feeling overwhelming. You're no longer scrolling through endless options wondering which one is the best. You're simply asking whether a fund does the job you need it to do. With that in mind, the next step is to set a few rules. Before picking any funds, you need rules, not flexible guidelines. Rules that force simplicity and prevent mistakes later. Rule number 1. Broad exposure. Don't make narrow bets. Don't focus on one sector, one theme, or one idea. If a fund depends on a specific outcome to work, skip it. Broad exposure means the portfolio benefits from overall economic growth, not from guessing what wins next. Predictions fail over time. You don't notice the mistake immediately, but it shows up as underperformance or constant changes. Broad exposure removes that problem. Rule number 2, low maintenance. Avoid anything that requires frequent attention. If a fund makes you feel like you need to monitor it, rebalance constantly, or rethink it every year, it's the wrong fund for a beginner. Investing should run in the background. The more attention it demands, the harder it is to stay consistent. Rule number 3, buyable in bad markets. If you wouldn't feel comfortable buying a fund when markets are down and headlines are negative, don't build your plan around it. Fear is part of investing. The strategy has to work even when confidence is low. This rule filters out fragile ideas. Strong strategies don't rely on perfect conditions, they work when things feel uncertain. When you apply these three rules together, most funds fail immediately. Some are too narrow, some are too complex. Others look good on paper but fall apart emotionally when markets drop. That's the point. The goal isn't to keep options open. The goal is to remove bad options before they become costly mistakes. With those rules in place, most funds disappear immediately. What's left is a very short list, and I've narrowed it down to 2 index funds. The first one is the core of the entire setup. That fund is FITLX, short for Fidelity U.S. Sustainability Index Fund. If I could only choose one fund as a beginner, this would be it. FITLX represents ownership in a wide range of major U.S. companies. Not a handful, not a narrow bet. It holds close to 300 businesses spread across the parts of the economy that actually drive long-term growth. If you look at the holdings breakdown, the structure makes sense right away. Technology is the largest piece because that's where much of modern growth comes from. Right behind it are communication services, financials, healthcare, consumer businesses, and industrials. Growth sectors are present, but they're balanced by industries tied to everyday spending, essential services, and real economic activity. Technology pushes innovation and expansion. Healthcare and consumer companies add durability. Financials and industrials connect the fund to the broader economy. No single sector dominates the outcome. Together, they reflect how the U.S. economy actually functions. If you scroll through the top holdings, you'll see familiar names, large technology companies like Apple, Microsoft, and NVIDIA, established healthcare firms, major financial institutions, consumer brands people use every day. No single company defines the fund. None of them needs to be monitored individually. The outcome comes from owning all of them together as a system. That's exactly what I would want as a beginner. Long-term investing isn't about finding the next big thing. It's about participating in growth that already exists. As U.S. businesses grow earnings, expand operations, and improve efficiency, their value tends to rise over time. FITLX is designed to track that process, not to outguess it. You can see that clearly on the price chart. Since its inception, the share price of FITLX has been up a little over 200%. That chart reflects price appreciation only. And if you average that price growth out year by year, it means the fund has grown about 13.03% per year on average. That's the core engine of this fund. Dividends sit on top of that growth. FITLX currently pays a dividend yield of about 1.11%. That yield isn't the focus, but it does add to long-term results when dividends are reinvested. More important than the yield itself is the growth behind it. Dividends from this fund have grown at an average rate of about 15.42% per year. That tells you the underlying businesses are generating more cash over time, which supports compounding. You don't need to manage any of this. You don't need to track individual companies, sector weights, or dividend payments. The fund handles the mechanics. Your job is simple. Own it and keep adding to it. This is why FITLX is the backbone of the entire setup. It's where most of the growth comes from. It doesn't rely on perfect timing or smart market calls. It relies on the idea that productive businesses as a group tend to become more valuable over long periods of time. And just as important, it's boring in the right way. There's nothing here to tweak or optimize every month. That's a feature. Boring funds are easier to hold when markets get noisy. The instruction stays the same. Keep buying it. Buy it when markets are calm. Buy it when markets feel uncomfortable. Buy it automatically without checking prices or headlines. This fund solves the growth side of the equation, but owning only U.S. stocks introduces one concentration risk that needs to be addressed next. In a couple of minutes, I'll show you the second index fund for my portfolio, and in the end, I'll show you how this exact two-fund portfolio can realistically turn a $9 a day investment into a portfolio worth over $1 million, paying more than $7,000 a month in dividend income. But first, let's address concentration risk. Here's the issue. When all of your investments are tied to one country, your outcome becomes heavily dependent on how that one economy performs over the long run. That's not a problem in any single year. It becomes a risk over decades. This isn't about predicting decline or assuming something will go wrong. It's about acknowledging concentration. If all of your money depends on one system, one set of policies, and one economic cycle, you've taken on a risk you didn't need to take. Don't overcomplicate the fix. You don't need to overhaul the portfolio. You don't need to add layers of complexity. You just need to avoid putting all the weight on one country. This is where many beginners make a mistake. They hear international diversification and think it means owning everything everywhere. That leads to 5 funds, overlapping exposure, and constant second guessing. Don't do that. You only need one intentional piece outside the U.S. The goal isn't global perfection. The goal is reduced dependence. One additional region is enough to meaningfully change the risk profile without making the strategy harder to manage. Different regions grow at different times. Sometimes the U.S. leads, sometimes it doesn't. Over long periods, spreading exposure makes the portfolio easier to stick with. That brings us to the second fund, VEUSX, short for Vanguard European Stock Index Fund. This fund does one job, and it does it cleanly. VEUSX gives exposure to large established European companies. These are businesses that operate in developed economies, sell products globally, and generate real revenue. This isn't about chasing what's next. It's about owning a different economic system alongside the U.S. That distinction matters. I'm not adding this fund to try and beat U.S. returns. I'm adding it to reduce dependence on a single country. Europe operates under different policies, different regulations, and different economic cycles. Over time, that difference matters more than short-term performance. If you look at the holdings breakdown, the structure is very different from the U.S. fund. Financials and industrials make up a larger share here instead of tech. Healthcare and consumer defensive companies play a bigger role. Technology exists, but it's not the dominant driver. That's intentional. European markets tend to be more value-oriented and income-focused. Banks, manufacturers, pharmaceutical companies, and consumer staples carry more weight. That gives this fund a different return profile, which is exactly why it belongs here. If you look at the top holdings, you'll see recognizable global names, companies like ASML, Nestle, Roche, AstraZeneca, Shell, and Siemens. These are established firms that sell products worldwide and generate steady cash flow. Just like with the U.S. fund, no single company defines the outcome. The result comes from owning the system as a whole. You can see that on the price chart. Over the last decade, the share price of VEUSX has been up around 88%. And if you average that price growth out year by year, it works out to about 5.89% per year on average. That's lower than the U.S. fund, and that's expected. This fund isn't here to lead on growth, it's here to balance it. Dividends play a much bigger role here. VEUSX currently pays a dividend yield of about 2.81%, which is meaningfully higher than the U.S. fund. That income reflects how European companies tend to return more cash to shareholders. What matters even more is consistency. Dividends from this fund have grown at an average rate of about 13.44% per year. That steady income stream adds a different kind of contribution to the portfolio when dividends are reinvested. And that difference is what reduces risk at the portfolio level. There's also a behavioral advantage here that doesn't get talked about enough. When part of your portfolio isn't tied to U.S. headlines, market moves feel different. You're less tempted to react to every domestic news cycle because not everything depends on it. That matters for consistency. This fund isn't something I plan to adjust, rotate, or replace. It doesn't need monitoring. It doesn't need opinions. It just sits there doing its job, balancing the portfolio over time. The instructions are simple. Add it once, keep buying it, don't overthink it. When you combine this fund with the U.S. core, the portfolio stops being about predictions and starts being about structure. 2 funds, 2 clear roles, no overlap in purpose. Once those roles are clear, the system is complete. What's left is deciding how much goes into each fund and how that fits into real life. I keep this simple. The portfolio is split 50-50 between the U.S. fund and the non-U.S. fund. One drives growth, the other adds diversification. Equal weight keeps the structure balanced and removes the need for constant judgment calls. The exact percentage matters less than people think. What matters is the split makes sense to you and doesn't invite constant tweaking. A clean, even allocation is easy to understand and easy to stick with, and sticking with it is what makes the numbers work later. Now, because the split is even, we can also look at the portfolio as a whole and understand what it's actually doing. Let's start with dividend yield. FITLX has a current dividend yield of 1.11%. VEUSX has a current dividend yield of 2.81%. Since there are 2 funds and the portfolio is split evenly, the math is simple. I add the 2 yields together, 1.11 plus 2.81 equals 3.92. And then I divide by 2 because there are 2 funds. So 3.92 divided by 2 gives us 1.96. Therefore, the portfolio dividend yield is about 1.96%. You can use the exact same add and divide by 2 method for the other metrics. Using the same 50-50 split, the portfolio's average dividend growth rate comes out to about 14.43%, and the portfolio's average share price appreciation comes out to about 9.46%. This portfolio isn't built to be adjusted every year. It's built to be repeated. New money goes in following the same split. It's also important to understand what this portfolio is not trying to do. It's not designed to generate income today. It's not designed to minimize short-term volatility. It's designed to grow purchasing power over long periods while reducing obvious risks. Now, there's one more thing almost every investing video skips. How much do you actually need to start with? Most beginners don't have $10,000 sitting around, or $5,000, or anything close to that. When you're just starting out, money is tight, and the idea of needing a big lump sum can be enough to stop you before you even begin. If this is truly a beginner portfolio, it has to work with what beginners can realistically invest. It has to be light on the pocket. It has to fit into real life, not some ideal scenario. So instead of thinking in terms of a big upfront amount, I think in terms of small daily contributions. For example, $9 a day. That's it. $9 a day works out to about $270 a month. It's small enough to be manageable, but real enough to compound over time. So what do the projections show if you stick with this? Let's start with the first year. With $9 a day, you would have invested about $3,285 after year 1. This sets the stage for future growth. At around 10 years, the portfolio is projected to be valued at roughly $57,948. At this stage, a large portion of the value comes from contributions, but growth is beginning to show up in a noticeable way. By year 20, the projection changes shape. The portfolio is projected at about $267,583. At this point, price appreciation and reinvested dividends are doing more of the work. Growth starts contributing meaningfully alongside those new deposits. At 30 years, the projection becomes much larger. With the same $9 a day and reinvested dividends, the portfolio is projected to be valued at approximately $1,246,966. By then, the majority of the portfolio's value isn't coming from how much you invested, but from how long the money stayed invested. Out of that total, about $1,148,416 is projected to be value added beyond contributions. That value comes from two places. Roughly $689,553 is projected to come from capital appreciation, while about $458,864 is projected to come from dividends that were reinvested along the way. By year 30, dividends also become visible on their own. The portfolio is projected to generate about $84,715 per year in dividends, or roughly $7,060 per month, while still remaining fully invested. These are projections, not promises. Markets won't move in straight lines, but the math shows what can happen when small contributions are allowed to compound without interruption. That's what $9 a day is projected to turn into over time in this simple two-fund portfolio. Want to see how a simple dividend portfolio can generate $1,000 a month, starting with as little as $2 a day? Click the video on the screen to see exactly how it's built.